Hello and welcome to the Monday, January 27th, 2020 edition of Tesla Daily, unofficial Tesla podcast. My name is Rob Maurer. Another pretty quiet news day today as we head into earnings, but we do have updated short interest to look at, and also the FactSet consensus estimates for Q4. Tesla stock on the day today was down, but actually a pretty strong day relative to the macro environment, finishing down 1.2% to $558.02. That compared to the Nasdaq, down 1.9%, as coronavirus continues to pressure the broader markets. Alex Potter, the analyst at formerly Piper Jaffray, now Piper Sandler, had an interesting note on this comparing it to the SARS outbreak in 2003, noting that the coronavirus, quote, is obviously impacting sentiment and many of our China-levered auto and truck names have been selling off, end quote. But after looking at the data around SARS in 2003, he found that actually there was a slightly positive impact on short-term demand for autos in China, which they hypothesized was driven by the goal of people to limit their public transportation to avoid human contact where possible. Interestingly, they also noticed that consumers tended to avoid dealers at this time, instead preferring to purchase and research online, which in 2003 was not the easiest of tasks. And they also found that price sensitivity declined during this period of time. So clearly all of those would work in Tesla's favor, so there shouldn't be any huge concern that this would impact Tesla too much from a demand perspective. And in fact, for the Model S and the Model X with the HEPA filter, I would assume would even heighten interest in those vehicles in particular. Potter does note that that short-term increase in demand was more of a pull-forward effect, and over the longer term, things normalized out to net neutral or slightly negative once SARS was contained. I think the biggest question for Tesla as it relates to coronavirus would be on the production front. Does this cause any shutdowns at Gigafactory Shanghai? We're getting some conflicting information out of Shanghai on this and whether or not there will be lockdowns or what the status of that is. On Friday, Disneyland in Shanghai shut down, and early in the day today, the Nikkei Asian Review reported that Shanghai, quote, on Monday ordered all but certain essential companies, including utilities and supermarkets, not to resume business before February 9th, end quote. However, later in the day, the South China Morning Post reported, quote, Gu Honghui, a deputy secretary general of the Shanghai government, said speculation about an impending lockdown of the city was a misunderstanding. City officials are closely monitoring the health situation before taking any major decisions that could affect business and daily activities, he added, end quote. So as of now, it doesn't look like there's a lockdown type of situation specifically in Shanghai, though there is more of one in Wuhan where the coronavirus outbreak really is originating, about 500 miles away from Shanghai. So as this continues to develop, we'll keep an eye on it. Obviously, there's the big macro impact, but also some potential micro impact, specifically on Tesla as well. Next up today, after market close, we did get updated short interest for Tesla for the January 15th settlement date. Short interest was down 1.3 million shares to a total of just below 25 million shares, still remaining sold short. That was about a 5% decline in short interest from December 31st to January 15th, while the stock price over that same period of time rose from $418 to about $518, or about 24%. So even though the number of shares sold short actually declined, short interest from a dollar perspective did increase from about $11 billion at last report to about $13 billion for the 15th. That 25 million shares that are sold short represents about 13.5% of the outstanding share count and about 17.5% of the float share count. So in terms of what this all means, to me, this number demonstrates the fact that this hasn't really been a short squeeze. From mid-December to mid-January, the stock price increased by 45%, while short interest only declined by about 2.5 million shares, or 9%. That's not that big of a decline. We've seen that many times from Tesla in the past. Back in September, in a 2-week period of time, short interest declined by more than 7%, and the stock price actually went down over that period of time. All other things being held constant, short interest declining does help the share price, but it's clearly not the main reason for the price increases that we've seen over the last month. Personally, I'm fine with that. I'd probably actually prefer that because that just means that the price is still being suppressed by all of that short interest that's out there. And my point of view is that over time, that short interest should continue to decline, meaning that the higher the short interest is, the more upside there is for Tesla. Definitely an interesting report, and our next update will be on February 11th for the January 31st settlement date. Next up today, I wanted to talk about the FactSet consensus estimates for Q4. And as always, when we talk about this, it's not really because I care all that much about what the consensus is. This is more important from a sentiment perspective because a lot of media outlets use the FactSet consensus when they're reporting on Tesla's Q4 actuals. So these numbers often set the benchmark for whether the media covers Tesla's earnings as a beat or as a miss. The last update that we had on the FactSet consensus came just a few days before the Q4 delivery report came out. So first we'll talk about how the Q4 expectations have changed since that report, and then we'll also talk about the full year 2020 expectations, since we'll likely receive some sort of guidance from Tesla on that on the Q4 earnings call. There are quite a few numbers here, so I'll also tweet this out and put those in the YouTube version. But the revenue expectation from the FactSet consensus currently sits at $6.99 billion compared to $6.77 billion on December 30th. The GAAP earnings per share estimate sits at 43 cents per share versus 32 cents per share on December 30th. Non-GAAP EPS at $1.65 versus $1.33 on December 30th. And free cash flow at $429 million to the positive versus $331 million to the positive previously on December 30th. For what it's worth, I think Tesla should pretty easily beat on all of these numbers. Revenue certainly, I think, should be probably above $7.2 billion. EPS, there's a bunch of factors that can influence that, like foreign exchange that we saw last quarter. But I think Tesla's going to continue to improve margins, probably to the surprise of many. And that could lead to an EPS beat of maybe 100% or so. Call it maybe $1 above these estimates. And if that happens, obviously the outlook for free cash flow improves significantly, with that line then just coming down to how much Tesla spends in capital expenditures. The problem with all of this is that I think, based on the stock price, that Wall Street expects a beat, so I don't think this really gives us, in this particular earnings report, much of a benchmark to judge for how the stock is actually going to react to what Tesla posts. As I said, you would think that this would help the media sentiment, but let's say Tesla posts a beat on all these numbers, and then after hours the stock trades down 5%, 8%, something like that. Well, if that happens, the media headlines aren't going to be talking about a beat, they're going to be talking about a miss, regardless of what this FactSet number is. So this is a tricky one, especially because this should be a little bit more forward-looking of an earnings call, knowing that we're heading into 2020, and the expectation would be for some sort of annual guidance. That can obviously have a huge impact on the stock, regardless of what the Q4 results are. And then we should get updates on 3 major product lines for Tesla, the Model 3 from Gigafactory Shanghai, the Model Y, and hopefully Solar Roof. And you also never know what they're going to talk about with autonomy either. So a ton going on. I mean, I think we expect pretty positive updates on most, if not all of those things. And then you pair those updates with strong financials, and my outlook is positive. But again, a lot of these things are reasons the stock price has increased so much already. So for this particular report, I think it's just extremely difficult to get a feel for what the expectations truly are. As we look ahead to 2020, I think, again, FactSet consensus estimates are low. The estimate for deliveries for 2020 is 468,000. That's only up 5,000 deliveries from the 463,000 expectation when we looked at it in December. Revenue expectations for the year are just below 30 billion at 29.9 billion. That's up nearly $1 billion from the roughly 29 billion expectation back in December. On the earnings line, expectations have gone up there as well since December. The GAAP earnings per share estimate has increased from $2.33 in December to $2.96 now, again for the year 2020. And the non-GAAP EPS estimate has increased from $5.84 per share to $6.78 per share. Interestingly, free cash flow expectations actually came down slightly to $860 million for the year versus $877 million previously. I definitely expect these numbers to come up after the Q4 report. 468,000 deliveries for the year would only be about 27% growth over 2019 for Tesla in terms of unit deliveries. That would be the lowest growth year in Tesla's history, well below their 5-year compound annual growth rate of about 63%, which doesn't make a ton of sense knowing that we have Gigafactory Shanghai coming online this year as well as Model Y production. I think 550,000 is a much more reasonable expectation, and it wouldn't surprise me if Tesla pushes to get that number above 600,000. 600,000 would represent that 63% growth rate, again in line with the 5-year compound annual growth rate. Now, conventional wisdom says that those growth rates are harder to maintain as you build a bigger base because they actually become more and more units over time. But as I alluded to in the question for the earnings call, Tesla's compound annual growth rate has actually been accelerating over time, which is actually pretty incredible. In terms of guidance, I think we need to be a little bit careful here with our expectations though, because I think Tesla is trying to shift away from giving specific guidance where possible. Let me first give you an example from back in early 2017. So 2017, of course, being the year when Model 3 production started. On the Q4 2016 letter, when most people would be expecting Tesla to give their 2017 guidance, they said that they were only going to give guidance for the first half of the year, saying, quote, "Since even a couple weeks shift in timing could have a meaningful impact on total deliveries and installs, we are focusing our guidance on the first half of the year," end quote. That's not entirely dissimilar to the situation we're in now with Gigafactory Shanghai and Model Y ramping up at the beginning of this year. Then fast forward to 2019. In Q2, Tesla said, quote, "This quarter, we are simplifying our approach to guidance. We are most focused on expanding our manufacturing footprint in new regions, launching new products, and continuing to improve the customer experience while generating and using cash sustainably," end quote. Later continuing on to say, quote, "We are working to increase our deliveries sequentially and annually with some expected fluctuations from seasonality," end quote. Which I would also note that almost that exact same statement showed up in the Outlook section for the Q3 earnings report as well, with Tesla both times referring back to their annual guidance. So we already have a precedent of Tesla not offering full year annual guidance back in 2017. And then we also have Tesla on record saying they're changing their approach to guidance within the last 6 months, and then also giving us less information than they would have historically. I don't necessarily expect Tesla to not give guidance. I think between the shareholder letter and the earnings call, we'll probably get some sort of guidance. But I think this idea is worth considering, and I won't be surprised if what they give us is pretty vague. That will do it for today, though. As always, thank you for listening. I also encourage you to follow me on Twitter at Tesla Podcast. And if you want to support the podcast, you can find more details about doing that at patreon.com/Tesla Daily Podcast. Don't forget to subscribe, and I'll see you tomorrow for the Tuesday, January 28th episode of Tesla Daily. Thank you.